morning and welcome to IG's early morning call with me, Angeline Ong, on IGTV. It's the 14th of March and there's lots happening. Let's get you across the markets before they open. Here are the headlines. European equity markets are hesitant after yesterday's sell-off. Investors licking their wounds as the SVB impact continues to unfold. Now, is a Fed hike no longer on the cards? The dollar remaining weak after SVB and ahead of that CPI number. And investors fleeing to safety. Gold settles above 1,900 as investors flock to the perceived safe haven asset. Now, with 30 minutes to go until the European market open, this is how the pre-market is looking across Europe. Let's check on the VIX first, because the VIX, known as the fear gauge, is coming off there. As you can see on this cursor of mine, it has been quite high since the collapse of SVB, but it is coming off those peaks now. Let's take a look at the FTSE as well. Here's the FTSE for you. We are seeing some signs of a slightly lower open across Europe. This is the CAC 40, the France 40 on the IG platform. Same story there. And here is the DAX as well, or otherwise known as the Germany 40 on the IG platform. We are looking at futures pointing to a slightly lower open, as I mentioned earlier. This was after the FTSE dropped 2.5% in the previous session. The DAX just over 3%. Now, banking stocks led the losses on Monday's session. The stocks banking index fell 5%. I can show you that move right here. This is the stocks banking index. Look at that red candle there. And this was because of investors worrying about the fallout from the collapse of SVB. Commerzbank lost 12.7% and Credit Suisse fell more than 9% to a record low. We'll come back to that Credit Suisse story in just a moment. Overnight in Asia, we had similar falls in Japan. Banks as well led losses overnight. Sumitomo Mitsui lost 8%. Resona fell some 9%. Hang Seng down as well. And the ASX 200 also registering losses there. On Wall Street, we had a similar painful fall as well. The Nasdaq, though, managed to eke out a gain at the close. SVB itself fell another 63% yesterday. Now, this is really key for us to watch because, and I can pull up the chart here, because SVB and the fears of contagion has been what has been moving global markets and global financial assets recently. Now, in the US, some regional banks as well were hammered. Just a few names. First Republic Bank down 61%. Western Alliance Bancorp down 47%. Zions Bank Corporation down 25%. And PacWest down 21%. Major banks also fell, but to a lesser extent. Now, Bank of America fell 4% around there. Citigroup nearly down 7%, or down nearly 7%. Wells Fargo down 5.8%, and JP Morgan lost 1.3%. The total damage, well, major banks, they saw some $90 billion wiped off their market cap. Two-year treasuries, though, had their biggest rally since 1987. And the market priced out any chance of a 50 basis point hike at the Fed's next meeting. Instead, Fed fund futures are now indicating a 70 basis point cut by year end. So quite a huge change there in interest rate thinking. US trade ahead of the Wall Street Open, well, that could be quite choppy. Let's have a look at the chart here for you as there's still quite a few hours yet to the Wall Street Open. But it could be choppy if that wall of worry surrounding SVB's collapse persists. Let's take a look at Australia now, because we have had quite a few data points out from Australia. We had the Westpac consumer confidence data there remaining at 78.5, holding near historical lows. This is as high inflation and rising interest rates continue to weigh on household budgets. NAB business confidence fell 10 points to negative 0.4 in February, erasing the bounce of last month. The survey paints a mixed picture, though. On the one side, business conditions remain resilient with strong sales and employment, but here too, high inflation and rising interest rates had a very negative impact And also, don't forget, there's a lot of reaction as well to SVB, so much so that it is impacting the dollar, not so much those data points that I mentioned earlier. You see, the collapse of Silicon Valley Bank has also meant that investors are now putting off bets on further rate hikes by the Reserve Bank of Australia. And this is even though analysts say domestic data will guide the RBA, not SVB. But as you can see from this chart here, the expectations for perhaps another rate hike are coming off, just like the Fed. Moving on now, we've got data out of the UK, unemployment data to be specific. The rate remains at 3.7% in January. Economists had anticipated a rise of 3.8%. Now, plenty of other news out there. As we saw earlier, the collapse of Silicon Valley Bank and Signature Bank raised doubts on whether or not the Fed will continue to pursue its aggressive rate hike policy or trend in the coming week. Looking at Fed fund futures, 50 basis point hike, that expectation is now off the cards. But could the latest US inflation data start to shake things up? Well, this is what we're looking at today. The US Consumer Price Index is expected to rise 6% in February year on year, decelerating from the 6.4% recorded in January. Core CPI also forecast to ease to 5.5% year on year after 5.6% in January. It follows Friday's jobs report, which showed a still tight labour market with more than 300,000 job creations last month. But it also indicated that wage inflation remained on a downward trend, down 0.2% month on month, the lowest increase in a year. Now let's take a look at the euro-dollar cross now. Current option prices show that traders of this forex derivative expect more forex volatility to be generated from Tuesday's CPI than Friday's US jobs data alone. And overnight, the implied volatility for this cross is 20 versus 14 pre-NFP and 10 on a typical trading day with no event risk premium. So it's quite a big volatility change that we could be looking at when we get that CPI data later today. Now let's also look out for Close Brothers at the open. Now this is the company that gives us perhaps an overview or forward-looking indicator into the US economy. Just pulling up the chart for you here. The group declared a statutory operating profit before tax of £11.7 million in the first half of its fiscal year, down from around £128.9 million in the same period a year ago. Performance mainly due to a provision of £114 million in relation to its loan providing branch, Novitas. Last month, Close Brothers took the decision to permanently cease the origination of new loans and wind down the Novitas loan business. Now, Old Mutual also reporting a 10% rise in full year profit. Let's take a look at the chart here for you. Old Mutual is, of course, the largest life insurer in South Africa, and it said it benefited from a drop in mortality claims in its biggest life insurance business. But the outlook remains risky for insurance firms in the context of rising interest rates and tough domestic economic conditions. Old Mutual declared a dividend of 51 cents per share. Moving on to the auto sector and Volkswagen, where the future for Volkswagen, it seems, is electric. It's investing 180 billion, that's billion euros, in the next 5 years towards this aim. 2/3 of that amount will be spent on electrification, including making batteries and digitalization in China, up from 56% in the previous 5-year plan. Volkswagen also wants to increase its presence in North America. Let's have a look at the chart for you. Volkswagen coming up here, like a lot of the car makers, Volkswagen has been coming up with so many headwinds First, there's the transition to electric cars, and there's also been the supply chain shortage, and not to mention Brexit, not to mention COVID. The car industry has been pounded, and they've been struggling to keep up with all these changes. In terms of earnings, Volkswagen says its earnings margin reached 8.1% at the upper end of its 2022 forecast. It also expects supply chain bottlenecks to ease in 2023. And that's a look at Volkswagen ahead of the open. 20 minutes to go. Now, as I said at the start of this program, Credit Suisse fell to a record low, a new record low, might I add, in the previous session, dropping another 9.6%. Earlier this morning, the Swiss bank published its 2022 annual report, and according to the document, customer outflows had stabilized to much lower levels, but had not yet reversed. I'm just having a look at the chart here for you because Credit Suisse is quite an interesting chart, to say the least, because it's been so embattled. It's had scandals, it's had so many changes in its leadership. You can see quite a clear downward trend there on the technical analysis chart. Seems to be stuck in that 294 to 240. In fact, it's broken through that 250 mark now and heading lower. But as you can see, it's been making lower lows pretty much since 31st of March 2022, or April 2021 rather. It's progressively slipped lower and lower. The bank has been trying to turn itself around and been trying to change its leadership to ensure that the bank starts to realize profits. But it's key there, as I said, until we see it break out of that 294 level, we are not, or even the 271 level, as you can see here on the perforated line, we're unlikely to see it go up to back up towards the 360 level. I've left that perforated line for you as the next resistance level. At the moment, it's broken through 247 and is heading lower. Now, the collapse of SVB Bank didn't help either, because that sent investors away from banking stocks, and many of them fleeing to perceived safe havens such as gold. And this has sent the commodity, the precious metal rather, to a 5-week high above the 1,900 level. Let me just show you gold here, because it is quite astounding, the march upwards. There you go. It's now at around 1,911. And as you can see there, a clear march upwards since the SVB debacle. If you want to read more on gold and the impact of the recent events, do search for Daily FX analyst Tammy DaCosta, who has written extensively on this subject. Moving on to the oil market now, Brent fell below $80 for the first time since February 6th, shedding more than 2% in a very volatile session. Let's pull up the oil chart for you, because oil has broken new lows. As you can see there, it's gone past that resistance level and is now heading further lower to 74.07. And we can see it's just passing that line of resistance there, and it's clearly broken through 7,600. So if volumes remain the way they are, we could see this creep lower to 7,200 and perhaps further still. It's not just SVB, mind. Chinese data also showed consumer inflation there slowed to the slowest rate in a year in February, as shoppers remain cautious. This is despite the reopening. Now, this all feeds into the oil market because it's causing concerns over oil demand, and China is, of course, the world's biggest oil importer and biggest consumer after the US. Well, before we go, let's take a last look at the European equity markets ahead of the open. Here's a look at the DAX for you, the German 40. It's down, actually, it's looking like we could see potentially a flat open now. Here is the CAC, Corons, and the FTSE for you just before we go. also looking like either a flat or slightly lower open. And that's your early morning call. Do follow us on Twitter, and don't forget we've got charting at 10:30.